Last Sunday, Polygon had the lowest weekly candle close ever for the POL token, 9 cents. If you look at social media, you'll see nothing but extreme fear, capitulation, and retail abandoning their positions at a massive loss. But there's a glaring, massive disconnect between what the chart looks like to an amateur and what the on-chain data is screaming at us. While most are panicking, the largest financial institutions on Earth are quietly laying the groundwork for a $3.5 trillion migration onto this exact network. We are seeing a complete restructuring of Polygon's tokenomics that could push real yields to 11%. We are seeing all-time highs in network throughput, and we are seeing a bullish divergence on the weekly momentum oscillators that suggests a massive trap has been set. Today, we are entirely ignoring the noise. We are going to look at raw, verifiable institutional data, and then we are going to look at the weekly chart to define exactly how I'm managing my risk, my hedges, and my long-term macro bags. Let's get into the data. To understand where Polygon stands today, we have to zoom out and look at the psychological damage that has been inflicted on this market. Ever since the massive migration from the old MATIC token to the new POL ticker, the price action has been brutal. At the end of 2024, POL hit its post-migration all-time high of 75 cents. Since then, it has been a systematic, slow bleed inside of a massive descending channel, wiping out hope and liquidity along the way. Right now, we are hovering around 9 cents. The sentiment is completely washed out. Nobody wants to touch Layer 2 scaling solutions right now because the broader narrative has shifted. But as a sophisticated investor, this is exactly when you need to start paying attention. Peak fear is where generational risk-to-reward ratios are born. The reason this video matters right now, at this exact price point, is because market structure is entirely dictated by liquidity. When retail leaves, institutions build. We are currently sitting right above the ultimate bounce zone of 8 cents, which acts as the absolute floor for this asset. The amateur looks at 9 cents and sees a dying project. The professional looks at 9 cents, then looks at the enterprise adoption metrics and asks a very different question. What does Wall Street know that the retail trader does not? To answer that, we have to look at the fundamental catalysts that are fundamentally rewiring the value capture of the POL token. There is something happening under the hood that completely changes this picture. Let us start with the heaviest data points, because the scale of capital moving onto Polygon is difficult to comprehend until you look at the raw numbers. Recently, the Apex Group, a financial giant servicing $3.5 trillion in assets, partnered with Tokeny to launch the T-Rex chain. This is a compliance blockchain built specifically for institutional capital markets, and it's built entirely on the Polygon Cloud Development Kit. They have committed to bringing $100 billion worth of real-world assets on-chain by the end of 2026. Let that sink in. $100 billion of real, traditional finance capital being tokenized on Polygon infrastructure. And they are not alone. When you look at the macro mapping of enterprise partnerships, it's staggering. Visa, JP Morgan, Stripe, BlackRock. We recently saw Polygon natively integrate with the Mastercard Crypto Partner Program, bridging on-chain settlement directly to global traditional payment rails. When Franklin Templeton, an asset manager with $1.7 trillion under management, needed a public blockchain to run the first United States registered government money fund, they also chose Polygon. That fund now has over $1 billion operating smoothly on the public ledger. Enterprises don't experiment with their payment infrastructure. They require absolute security and scale, and they are overwhelmingly choosing this network. Why are they choosing it? Because the legacy financial rails are entirely obsolete. If you send money through the traditional SWIFT network, it costs you anywhere from 0.5 to 1.5% in fees, and it takes 1 to 5 days to settle. If you run those same stablecoin rails on Polygon, the transaction cost is less than 0.1%, representing a 90% reduction in costs, and it settles in under 30 seconds. This is why Polygon recently crossed a monumental milestone of over $2 trillion in historical stablecoin volume transferred. It's proven at scale. In fact, stablecoin usage is going parabolic. We just saw over 3 million monthly active USDC addresses, driven heavily by prediction markets like Polymarket, which facilitated $1.1 billion in volume in a single week, pushing Polygon to an all-time high over 150 million stablecoin transactions. But here's where the thesis gets incredibly bullish for the actual token holders. Historically, a layer 2 could have massive usage, but the token itself suffered from high inflation and poor value accrual. That's changing right now. The network is undergoing a massive tokenomic shift through a new Polygon improvement proposal that shares network priority fees directly with delegators. Right now, stakers earn about 2.8% strictly from inflation. With the new fee-sharing model, that yield can push up to 11%. That's an 8% real yield derived entirely from actual network traffic, which is more than 3 times the yield of staked Ethereum. This creates a massive economic flywheel. Over 33,000 delegators are now earning priority fees. 105 validators are growing. When you introduce an 11% real yield on a token, institutional capital will lock up the liquid supply to harvest that passive income. They are even making it frictionless. You can now stake your POL directly from your Ledger hardware wallet, choosing your validator without ever moving your funds off cold storage. Furthermore, ecosystem projects like Avail, Katana, and Maiden are confirmed to be dropping airdrops directly to POL stakers in 2026. You are getting compounding yield on an asset that's trading at historical absolute bottom prices, and the network capacity is expanding to meet this incoming demand. Polygon is moving into shipping mode, upgrading the network to a 120 million gas limit, which brings the maximum throughput to over 2,800 transactions per second. In live environments, Polygon just processed 143 transactions per second, consuming 41 million gas per second. To put that in perspective, in that same window, the base network was at 85 and Ethereum was at 47. Polygon is literally outperforming its closest competitors by nearly double the actual on-chain throughput. This speed is critical because of the next major narrative, the agentic economy. Polygon just launched the Polygon Agent command line interface. It's a one-install tool that allows AI agents to instantly create wallets and transact on-chain. We are already seeing Polygon rapidly capturing market share for API facilitators using the EX402 protocol. When AI bots start streaming fractional machine-to-machine microtransactions 24 hours a day, they require the exact high-speed, low-cost environment that Polygon provides. To bring all this liquidity together, they have introduced Polygon Trails, a chain abstraction protocol that aggregates every balance across every chain into one single interface, allowing one-click execution regardless of what token or gas you hold. It removes all friction. When you look at the token terminal data over the last 90 days, the dominance is undeniable. Polygon processed over 680 million transactions. They rank second globally among all Layer 1 blockchains for ecosystem-bridged stablecoin supply, holding $2 billion, which is 14.6% of the market share. They rank sixth in global token holders with 134 million unique addresses, ensuring massive decentralization. They burned $7.3 million in base fee revenue over 90 days, exerting deflationary pressure on the token. And most importantly, they rank sixth globally in daily active users with 746,000, natively outpacing the Aptos network at 708,000 and completely beating the Ethereum base layer, which sits at 637,000. The fundamentals are not just strong, they are the strongest they have ever been in the history of the protocol. So, why is the price at 9 cents? For that, we have to transition to the technicals. Let us pull up the weekly chart for Polygon. I want to be perfectly clear about the macro environment here. The trend context is undeniably bearish. Price is sitting below all of our key exponential moving averages, the 10, the 21, and the 55, represented by the blue, red, and purple lines on my chart, are all sloping downward and acting as heavy dynamic resistance overhead. Since the migration and that massive top around 75 cents in late 2024, price has been perfectly contained inside of a massive multi-year descending channel. which I have marked with the orange dotted lines. This channel is the absolute governing structure of the market right now. Recently, we saw the price slice down and test the middle of this channel, represented by the white dotted line. The middle of a channel often acts as a massive psychological magnet and a pivot point for algorithmic trading bots. We got a bounce off that midline, moving into the upward half of the channel, but the momentum was severely lacking, leading to last Sunday, where we printed the lowest weekly candle close in the history of the POL token.
However, price action alone can be highly deceptive during capitulation phases. We need to look at our support and resistance subs. The absolute floor of this asset, the last major bounce zone, and the all-time low sits just below us at 8 cents. Overhead, we have a heavy confluence of resistance. If we anchor a Fibonacci extension tool from the swing high of 16 cents in June 2025 up to the local peak of 29 cents in August 2025, we get our downside extension targets. The 1618 Fibonacci level is sitting right at 11 cents. This is our immediate wall. Above that, the next major resistance is at 13 cents, which aligns perfectly with the upper boundary of our descending channel. But here's where the technicals get incredibly interesting and where the smart money trap begins to reveal itself. If you look at the indicator below the price action, we are running the Heikinashi Relative Strength Index. It's currently re-entering the oversold zone and is pointing down, reflecting the severe bearish price action. However, look closely at the yellow arrows I have drawn. Despite the price making a significant lower low on the weekly time frame, the indicator has made a higher low. This is a confirmed massive bullish divergence on a macro weekly time frame. A bullish divergence indicates that the downward momentum is exhausted. The sellers are running out of coins to dump, and the underlying strength of the asset is actually increasing despite the falling price. This brings me directly to my position strategy, because analyzing a chart without an execution plan is entirely useless. As I have documented in my previous videos, I'm managing a large, long-term spot bag of Polygon. When we hit my first macro take profit target back in January, I secured some profits to reduce my average entry price. But when the price pulled back recently and broke down to make a lower low, that was a mechanical trigger for me. I immediately opened a small hedge short position, using exactly 1x leverage, targeting the 6-cent area. The purpose of this short is not to bet against Polygon. The purpose is capital preservation. It protects the downside value of my long-term portfolio. My stop loss for this hedge short is strictly placed at 12 cents, but with a specific condition. The weekly candle must physically close above 12 cents for invalidation. Wicks do not matter, only the closing price dictates the structure. If Polygon manages to reclaim its strength and closes a weekly candle above 12 cents, it proves that this lower low was a deviation, a bear trap. If that happens, it's back in the game. I'll immediately close my hedge short at a small, defined loss, and I'll let my long-term bag run freely to the upside. If you are a new, conservative buyer looking to deploy capital, stepping in front of a falling knife at 9 cents carries risk. The high probability play is to wait for a confirmed weekly close above that 1618 fib level at 11 cents. Reclaiming that level signals a structural shift in momentum. Despite the extreme fear in the market right now, I'm absolutely not selling a single token of my long-term spot bag. The fundamentals we just discussed are too strong. At a minimum, I'm waiting for the Heikinashi Relative Strength Index to flip and cross all the way back up into the overbought territory on the weekly chart before I even consider taking macro profits. When the trend eventually reverses, I employ a strict scaling methodology. My take profit targets, marked by the green circles on the chart, are specifically set at 16 cents, 20 cents, 25, 42, and ultimately 60 cents. I use a mechanical trailing stop system. When the price hits my first target of 16 cents, I take partial profits and immediately move my stop loss to my original entry price. It becomes a risk-free trade. When the price hits target 2 at 20 cents, I move the stop loss up to target 1. I continue this laddering process all the way up, removing emotion entirely from the equation and securing yield at every major resistance level. Now, if you are sitting there wondering exactly how to build these trailing stop systems, or you want to see the exact minute I execute these scaleouts in my own portfolio, this is exactly what we do inside the Pro Capital Vault. This is my private Discord community reserved for my YouTube members. I don't just post charts, I post my exact execution. You get real-time portfolio tracking, precise buy and sell zone alerts,
weekly live strategy calls where we dissect the macro environment, and a comprehensive Sunday prep report to front-run the week. It's built for serious position traders who want to remove the guesswork and trade alongside a data-driven veteran. If you want direct access to me and the War Room, click the join button right below this video or use the link pinned in the comments. Once you join through YouTube, just sync your account to Discord and it'll automatically unlock all the private VIP channels. It's the logical next step if you want to elevate your risk management. Now, synthesizing the fundamental data with our technical reality presents a very clear game plan. We are operating in a highly contrarian environment. The worst case scenario is that the broader crypto market suffers a macro liquidity shock, dragging Polygon down through our 8-cent support. In that scenario, my 1x hedge short prints money all the way down to 6 cents, offsetting the unrealized loss on my spot holdings, keeping part of my bag equity stable. The best case scenario is that this current price action is the final capitulation wick. The bullish divergence plays out, the market prices in the new 11% priority fee yield, and institutions begin locking up supply for the T-Rex chain integration. If we reclaim 12 cents, my short is stopped out, and the structural path to 25 cents and beyond is entirely open. My thesis is grounded in probabilities, not certainties. The data dictates that the downside risk from 9 cents is extremely limited compared to the asymmetric upside potential generated by trillions of dollars of traditional finance capital entering the ecosystem. The timeline here is mid to long term. You cannot rush institutional adoption. The only thing that would completely invalidate my bullish macro thesis would be a catastrophic failure of the Polygon network itself, or a complete abandonment of the chain by its enterprise partners, neither of which is happening. In fact, the exact opposite is occurring at a record pace. In my honest opinion, Polygon is experiencing the greatest fundamental expansion in its history, capturing massive institutional capital and entirely revamping its tokenomics to provide extreme real yield. Simultaneously, the technical chart is showing a deeply oversold market, with confirmed weekly bullish divergences sitting right on historical support. The strategy is to hedge the immediate downside risk while aggressively positioning for the macro reversal, using strict invalidation levels to protect capital. Remember, the market is designed to transfer wealth from the impatient to the patient. Do not let short-term price volatility shake you out of a fundamentally superior asset class. Stick to the data, manage your risk, and let the chart make the decisions for you. If you found value in this deep dive, please hit the like button and subscribe to the channel. It helps push real, data-driven analysis out to a space that is unfortunately filled with hype. None of this is financial advice. This is simply my exact read on the market structure. To fully grasp the scope of this accumulation phase, I highly recommend you go back and watch my last 2 videos specifically on Polygon. I update my POL thesis roughly every 2 weeks, and each video acts as a direct continuation of the previous one, mapping out exactly how this structural trade is developing in real time. Connecting those prior data points with today's analysis will give you a massive edge in understanding this market. Thanks so much for watching to the end. I hope you enjoyed it, and I'll catch you tomorrow for the next one.